Hey guys, RC Peck here. Hope you are doing well. So, I want to talk about Japan. I want to talk a little bit about real estate and probably the most important balance sheet on the planet. So, let's get into this. So, the first thing, I don't know if you saw this, but Japan's economy got a little smaller in the final quarter of 2019. Pretty amazing. It actually contracted over 6%. That's not me misspeaking. Over 6%. And so that just got me thinking. Okay, well, when was the last time Japan economy contracted 6% or more? And the answer was in Q2 2014. So I wanted to go back to Q2 2014 and look at the Nikkei. And here is Q2 2014 right here. And this is where it contracted. Now, what's interesting is the Abe economics started back here in 2012, but even with this huge contraction of 6% in the Japanese economy in the middle of 2014, the stock market still kept going higher. And if you look over here, this is the Japanese stock market. I believe this is around 25-year highs. It's got a triple top right now. So, what I love about this is if you hear about the third largest economy on the planet contracting by 6% in a quarter, one might think that's pretty bad for the stock market. But what's interesting is the Japanese stock market, the Nikkei, and this is priced in local currency, it hasn't moved. Now, of course, it can move down, and obviously it can move higher. But even after the people who learned, or the people who own the Nikkei, own the Japanese stocks, own the Japanese stock market, a negative 6% annualized GDP contraction has not phased Japan. And the reason why I just think this is so interesting is you've got to let price tell you whether it's important or not, right? Not just the information or the news or the hype or the fear, but you've really got to understand how to take what you hear and put it through a filter. And a 6% contraction, at least not recently, is not something that actually hurts the Japanese stock market. Pretty amazing. The next thing I thought was interesting is housing starts are breaking to not new lifetime highs. You can see on the screen, this was just highlighted here. This chart comes from Bespoke. But you can see that housing starts are moving higher. And what they wanted to point out is how housing starts peaked well before a recession. And housing starts are now breaking up to a new high since probably 2007. So that's 13-year highs. That's not bad. And so the real estate market is definitely not telling us there's a recession on the horizon. I wanted to see what this looked like just with the S&P Case-Shiller National Home Price. And these two vertical lines are the old lifetime highs in 2006 and 2007. And you can see that at least in the United States, the housing price index broke to new lifetime highs at the end of 2017 and moved up through 18 and moved up through 19. Now, this isn't adjusted for inflation, nor are any of my other charts that I usually show unless I say adjusted for inflation. So you have real estate at new lifetime highs too, and you have the stock market at new lifetime highs. You have bonds at new lifetime highs. So 3 of the 4 assets on the planet, bonds, also called fixed income, they're at lifetime highs, right? You have real estate, at least in the US, at lifetime highs. And you have the stock market at lifetime highs. The only one that's absolutely struggling is commodities. Pretty amazing. Now, part of the reason why this may be happening is because of the Fed's balance sheet, right? So we don't have to call it money printing. We don't have to call it quantitative easing. So without giving it a marketing spin, what we do know is the balance sheet of the Fed is going higher and started moving higher on September 11th, 2019. And you can see on the screen that this is in billions, 3.76 billion. the Fed started increasing their balance sheet. Now, just to put things in context, when the Fed increases their balance sheet, they have to create dollars. They create them out of thin air. And then they take these created dollars and they go out into the marketplace and buy stuff. And then that stuff they buy goes on their balance sheet. So what is that? 340 billion, 344, 40 billion, 523, something like that, close to it, 520 billion, also known as over a half a trillion, was increased. And so, of course, that has me thinking, how does that affect the stock market? And right here on September 11th of 2019, that's where the stock market was, did a little dip. This is the S&P 500 with dividends reinvested using the ticker symbol SPY. But I did the calculation. The S&P is up 13.3%, dividends included, since the Fed started expanding their balance sheet again. And these all kind of go together, right? Japan is going to have to figure something out with the contraction in their economy at 6%. The real estate market, which is a significant part of people's assets, housing starts are increasing. We're at lifetime highs with the case Shiller. Bonds are at lifetime highs. Stocks are at lifetime highs. And so it's okay to have, look, we could have all the assets hitting lifetime highs. There's no physics that says that can't happen. This is the market that we have. It may not be the market you want, but this is the market we have. And I give this final screen with the commentary of, are we being taught to care about the wrong things? So let me just describe what is on the screen. For anyone that wants to gripe about the concentration of the US stock market, here's some context. So what this is showing you is what percentage of stock markets around the planet are held by the top 10 holdings. For example, the 10 biggest holdings in Japan represent 19% of the entire stock market. Now in the US, the top 10 holdings in the US stock market represent 21% of everything. But then you go to the UK and their top 10 holdings represent 45% of their entire stock market. China's 10 biggest holdings represent 47% of their entire stock market. France's 10 largest companies in their index represent 49%. In India, it's 54%. In Australia, it's 54%. In Brazil, it's 56%. In Germany, it's 56%. So we are thrown numbers. We are thrown so much information. So much information is coming at us, right? We go from crisis to crisis, and now you have screens on your wrists and in your pockets and in your office and bathroom and bedroom and TV room. Do people call it a TV room anymore? And the kitchen. And all we're having is crisis to crisis to crisis. And more than ever, you've got to figure out, or the people who do well, they figure out how to filter that information, right? They figure out how to, once they have that information filtered, identify the emotion they're having, identify the behavior that they're having. And then the third step is they take appropriate action. And appropriate is code for you can take action and do in a way so when you do, even if you're wrong, you don't get hurt. So we definitely have some interesting things going on in the stock market. It would not surprise me, guys, if the stock market, I follow the S&P, and it would not surprise me, nor would I think it would be a bad thing if the stock market fell about 300 points on the S&P. That's about 10%. So generally speaking, the S&P is at about 3,300. And if it dropped down to 3,000, that would not surprise me. I'm sure bonds would absolutely go crazy. The fact is the market is going up as it is. and the price of bonds is going higher and the yield is going lower. Guys, we're going to see negative yields in this country, in the US, and there's already negative yields around the world. So we got interesting times, guys. Again, the key is to know how to filter that information to figure out what's hype, fear, and worry, and what is significant. Thanks so much, guys, for being in my world. This is just another step in helping you protect your portfolio and your future. Until next time, this is RC Peck.